Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who have subscribed to the channel. I really do appreciate it. The channel continues to grow because of people like you, and we are very close to 1,000 subscribers. So for those of you who have not done so, make sure you hit that subscribe button. Help me get to 1,000 subscribers. I know some of you out there are still watching the channel that haven't done that. So again, hit that subscribe button for me. On this channel, we focus on dividend growth investing. This particular video will be our portfolio update. We do these every Sunday morning. So we look at the dividends paid, anything that I bought or sold, any options that I was in, any activity in the portfolio overall. We will cover the $1,458 I did add to the portfolio and what I bought with that. But before we get into the video, again, for those of you who may be stopping by for the first time, it's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks and growing companies with positive cash flow that covers the dividend and companies with a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing into the portfolio on a weekly basis. And again, I cover those updates every Sunday morning. I also do larger purchases if I get a bonus or do a side job, something like that. I cover all my investments into the portfolio on this channel. I do not have a paid Patreon account. It's free to see what I'm doing. I don't intend to have a paid Patreon account. I don't have any paid paywalls. I'm not sending you to any other sites or anything to sign up for. I'm not trying to sell you any courses or anything like that. And to be honest with you, if there are channels out there that you are watching that are trying to sell you courses or that are making you pay for a paid paywall or a Patreon account, you should avoid those sites altogether. Do not let people charge you for stuff on YouTube. This should be free. I don't make any money off YouTube. I have a job, but once I get over 1,000 subscribers, any money that it will be made using the ad revenue from YouTube. And that's how people should get paid off YouTube, or people being promoted by other companies, something like that. But they should not be charging you as the viewer to see what they are doing in their portfolio, especially if they are not a professional. And I am not a professional. I'm just like you, an average person building out my portfolio, but I want to show every week what I'm doing, so someone out there who maybe is on the fence about starting a portfolio can see a real portfolio built out over time by an average person, the ups and downs of the market, and hopefully it gives you some confidence to start your own portfolio as well. So again, nothing to pay for here, but if you would like to help me out, if you could hit that thumbs up button down below, make sure you're subscribed to the channel, hit that subscribe button, join us on this journey to financial freedom, join the Vested Interest community. Hit that notification bell so you're notified whenever we put out any new content. And again, drop me a comment down below. What are you buying in your portfolio? What are you adding? What are you selling? What are you avoiding? Would love to hear from you. And that's what this channel is about as well. Us sharing our experiences so that other people don't make the same mistakes that maybe we have made in the past. And it's all right. We're all going to make mistakes. That's part of investing. Even the greatest investors in the world make mistakes. All right, now let's get into the portfolio. And now that should have said June 24th. But on the 24th, we did go in and put in the options play for Johnson & Johnson. Now, if you remember last week, this was assigned at a 148 strike price. So I went in thinking it was going to go up, continue to go up, and hit a 149 strike price on one contract. Sold to open one contract on Johnson & Johnson, ticker J&J, out of the healthcare sector. 149 strike price. Date of June 28th, which was Friday. And we did receive $111.45. And I know I only listed $11.45, but again, if you remember, last week we had the strike price at 148. So the $100 really is the needed amount to run this wheel again. So really, I only counted $11.45 in new capital out of the $111. So I didn't have to put any new capital in. And I did make a little bit on the options premium, but part of that 111 was to run this premium with the 14,800 from last week's assigned covered call. We wanted to run this cash secured put, so we needed $100 extra. So that's what you're seeing there, and why you're only seeing $11.45 accounted for in new capital into the portfolio, right? Because I needed that $100 as part of the cash to do a cash secured put, which is what we did here. So we did receive $11.45 in options premium, additional capital, and that goes right back into the portfolio. Now, those shares were assigned at $149. Unfortunately, it was under 149. I think it closed out the week at 146, maybe 147. So we paid a little bit more than we should have. We could have just bought the shares outright, but that's not what we did. And that's just the way options work sometimes. Now, we received dividends from several companies. This, and I should same thing. That should say June 28th. On June 28th, everything came in the last day of the trading week, as well as the last day of the trading month. We did receive $164.76. We received $38.47 from Bank of America, ticker BAC. This is a bank out of the banking sector here, out of the financial sector, I mean. And the $38.47 went right back in and bought 0.96368 more shares of Bank of America. We do have the DRIP set on. For those of you who may not know what that means, DRIP stands for Dividend Reinvestment Plan. And your brokerage probably has that. Maybe you have it set, maybe you don't. I use that because I want the funds to go right back in and buy more shares. I'm not using the funds to pay my bills yet, so I want to keep building out these positions. And that's all it really means. As a company pays out dividends, in this case, Bank of America, $38.47, it goes right back in and buys more shares of the same company. We also received $75.45 from Kraft Heinz Company, ticker KHC. This is out of the consumer staple sector. That $75.45 went right back in and picked up 2.33338 more shares of Kraft Heinz. And last but certainly not least, we picked up $50.84 from Union Pacific Corp, ticker UMP. This is a railroad out of the industrial sector. And that $50.84 went back in and picked up 0.22534 more shares. These new shares added an additional $5.82 in passive income over the next calendar year. And this, what you're seeing here, is the dividend snowball in effect, right? So I have already purchased shares of Bank of America, Kraft Heinz, and Union Pacific. Those shares that I already have in my portfolio paid out dividends, right? The $164.76. That $164.76 automatically goes right back in and buys more shares of those same companies, and those new shares add additional capital. That is the dividend snowball. You want to supercharge that, you continue to add to the same positions that are paying out dividends. And Union Pacific is on our list of stocks that we are looking to add to in the month of July. If you haven't seen that video, I released it yesterday, so go ahead and check that video out. The 4 stocks I'm looking to buy in the month of July. Let's keep going here. Now we'll get into the first new capital here. We did on the 24th here, we did add $636.47. With those funds, we continued to add to our Starbucks Corporation position. We're building this out, not quite to 100 shares yet, so we're going to continue to at least 100 shares, maybe a little bit over, while it's pulled back here. I think it dropped down into the 76 range, maybe 78 range this week, so we could have got a little cheaper, but we picked up those 8 shares of ticker SBUX out of the consumer discretionary sector for $79.56. And these 8 new shares added $18.24 in additional capital over the next calendar year. And we weren't done. We went in the very next day on June 25th, and we added another $821.69. And we really made the rest of our purchases for the week. I went in and went ahead and did that early. I had some other things going on this week, so I was concerned I wouldn't be able to get to it on Friday. So we went in and added our typical buys like the Vanguard and the SCHD one early in the week. And with the $821, let's just run through it here. We added 1 more share of Valet. I've been nibbling on this one, I think, every week. 1, maybe 2 shares, 3, 4 shares, whatever. I've got a little bit of extra cash after I buy the positions I want. I throw it into Valet, ticker VALE. This is out of the material sector. This is a mining company here. 1 more share. This is one of our weekly buys. Vanguard's Total Stock Market ETF, ticker VTI, and I'm going to buy this every week regardless of what the market is. We did pick up that 1 share at $268.07. SCHD, same thing. This is another ETF, the Schwab Strategic Dividend Growth ETF here, ticker SCHD. We are adding at least 1 share a week here to this position as well, and we're going to continue to add 1 share of VTI and SCHD every week going forward, probably until the end of time or until I no longer am adding to this portfolio. We pick up that 1 share at $78.96. 1 more share to our Pfizer position, ticker PFE. This is out of the healthcare sector. We picked up that 1 share at $28.29. This is another one I'd like to nibble on a little bit. Very high yielder here. CVS Corporation. This one actually dropped back down into the high 50s again. I think $58 that closed out the week, I believe. Ticker CVS. CVS Health Corporation here out of the healthcare sector. Added 2 more shares. And that put us right at 200 shares of CVS. This one I'd like to continue to nibble on as well, especially if it stays down in the 50 range. Not going to add a lot because I have over 200 shares, so I have a pretty big position right now, but I wouldn't mind adding, maybe another 10 shares, 20 shares over the next couple of months. And last but certainly, and we picked up those 2 shares at $61.78. And last but certainly not least, our Nutrien position got a little bit of love as well right before its ex-dividend date. So we added 6 more shares to NTR. This is out of the material sector as well. We picked up those shares at $51.92. These new shares, this $821.69 in the new shares that they bought, added an additional $27.12 to the portfolio. Total invested this week, $1,458.16, which added an additional $51.18 in passive income. Now let's run through the portfolio breakdown real quick. The sector weights here. Communications makes up 10.32% of the portfolio. Consumer discretionary sitting at 6.63%. Consumer staples sitting at 9.28%. Energy at 5.83%. Financial sitting at 6.10%. Healthcare makes up the biggest slice of the pie here at 14.31%. Industrial sitting at 6.44%. Technology makes up 7.09%. Materials at 9.98% of the portfolio. Utilities makes up 9.68%. REITs and real estate, I believe, still is, the second largest position here, but it's getting close between communications and REITs. But REITs is still number 2 at 10.82%, and then ETFs, the SCHD and VTI positions makes up 3.58% of the portfolio. So still the smallest slice, but starting to get built out there a little bit. The ETFs are. Eventually, I think ETFs will be one of the larger positions in the portfolio just because I add to it every week, whereas I divvy up the capital among these other positions, as I see value in them. So these will fluctuate over time, but I like to show you that I do build in diversity into the portfolio. Some sectors are going to pull back at different times, and you try to find the value in the sectors and in the companies that are pulling back, and let the ones that are running kind of stand on their own for a little bit, and then whenever they pull back, you switch it over and add to those ones and let the other ones stand on their own a little bit. Or at least that's how I do it. You can see here over on the right, portfolio sector weights, same percentages broke down as the pie here, but then I also list out the dollar amount allocated to each sector as well. Now here it is. I show this every week, and I know a lot of you come on the channel to see this built out every week. I do too. I go to a lot of different channels to see how the other people's portfolios are doing. Not that I'm comparing myself to them, but it is nice to see how people are doing, what different portfolios are adding or selling or holding. So I look at portfolios as well and other people's channels. Maybe one day I'll do a video on all the channels that I watch, but that's not what this video is about. We'll wrap this one up for the portfolio update. So as you can see here, and I'm going to continue to show this, whether the market's up, whether the market's down, whether the market's floating sideways, whether I'm up or whether I'm down. I'm going to show you my portfolio every week so you can see a real portfolio built out over time, the ups and downs associated with it. You're going to have positions in the green, you're going to have positions in the red. Right now, we've got a lot of positions in red, and when I see those positions in red, I see buying opportunities. If I liked those prices, for example, Cisco here, which is another one on my stocks to buy for July watch list. If I liked it at $49.54, why wouldn't I buy it at $47.51? It's cheaper, right? You don't run into a store with the intent to buy something, and then whenever you get into that store, see that there's a sale on what you wanted to buy, and then run out the door. No, you buy more of it, or you buy whatever you were going to buy anyway, and then buy something else. That's typically what we do as Americans, as people. We don't run away from sales unless it's the stock market. It seems like the stock market is the only market where whenever something goes on sale, people run out and want it. Well, should I sell it? What am I going to do? It looks like I'm losing money. Well, you haven't lost any money unless you sell it. If you sell it at a loss, then yes, you've lost money. But if you don't sell, you do not realize those losses, right? And then eventually these stocks typically tend to turn around. If the company's fundamentals are the same, if you understood the company you were buying, if you bought it at a fair to below value price, the red, I think Warren Buffett says it best, if you can't handle a 50% decrease in a single stock, you shouldn't own stocks. Maybe stick to ETFs, index funds, something like that. But stocks are going to go up, stocks are going to go down. If the fundamentals of the company haven't changed, they're still a good company, they're still making growing revenue, margins are still good, they're still expanding as a business, then you should be willing to buy more. Now, if the fundamentals of the company have changed, maybe revenue is declining, margins are collapsing, something like that, there's competition that wasn't there before, then maybe it's time to reassess and look for other options and maybe sell out of that position. But if the fundamentals of the company have not changed, you should not change your investing strategy, and you should be looking to adding more. Here's the ticker in this row here: total shares I own, current price as of the close of business on Friday, market value, average cost per share here, my purchase price, so how much I have into each position, whether I'm up or down. Again, I'm going to show you transparently every week what positions are up, what positions are down. You can see that. The red obviously means I'm down, the green means I'm up. Same thing here. This is percent up or down, what sector each one falls in, whether they're a quarterly, monthly, semi-annual payer. I do have a couple that are, maybe more than a semi-annual payer or less than a semi-annual payer here. Sometimes, where is it? SBSW, for example, sometimes they only pay once a year, but I've got them in the semi-annual payer. BABA was only supposed to pay once a year, but they look like they're adding a special dividend. So they're going to pay twice this year, which is the first year they're paying dividends. So I've got them in the semi-annual. I just can't make too many columns because then it gets a little hard to read. So I'm only going to keep the 3 columns. If they paid out 3 times a year, they'd go in the semi-annual column. If they pay out 2 times a year, they're going to go there. If they pay out 1 time a year, I'm going to plug them in there. Current yield as of the close of business on Friday, my yield on cost, portfolio weighting. So what we saw on the previous slide was the sector weightings. Here's each positions weighting in the overall portfolio. Estimated annual income in this column, payout months here, dividend growth year over year, and where it sits at 15% of its 52-week low. Let's talk about this for 1 second here. I use this as a high benchmark for what I'm willing to pay for a stock. For example, BABA, it's pulled back again. I can buy it up to $76.62. So I don't want this number, my average cost per share, to be over $76.62. So even if BABA was above $75.44, I could add to it so long as it didn't bring my cost basis over here. Well, we could even talk to Procter & Gamble a little bit. For example, my cost basis is $140.32. Now I can buy it up to $162.66. It's currently $164.92. So I've got this on my stocks to buy in July list. Even though it's over my cost basis and over where I want it to sit at 15% of a 52-week low, I can add to it, bring this average cost per share up slightly, but so long as I keep it under this cost right here, that's fine. So I'm going to do that. I'm going to nibble on Procter & Gamble, even though it's over what I'm willing to pay here, at over 15% of its 52-week low, above my average cost per share. I'd like to continue to build this position out, and I'm going to take the opportunity, since my cost basis is so low, to do that, bring up my cost basis a little bit, but I'm going to keep it under this, where it sits at 15% of its 52-week low, or $162.66. Yeah, drop a comment down below. If that wasn't clear, I'll try to clarify it a little better, but hopefully that makes sense. Total shares currently in the portfolio, 6,797.838. Cost of the overall portfolio, $259,396.26. I have $251,564.51 into the portfolio. That's my own funds put into the portfolio. I am up $7,831.75. I don't really focus on this. Currently a 3.11% return. Really don't focus on this either. Current yield of the overall portfolio, 4.395%. My yield on cost a little higher at 4.532%. And this is what I focus on. That is why it's circled in red. Whether the market's up, whether the market's down, whether the market's floating sideways, this continues to go up as I add new capital, as the positions in the portfolio pay out dividends, which is what we saw with Union Pacific and Bank of America and Kraft Heinz this week. As those new shares add new shares, right? As those dividends buy new shares. And the other way it grows is as the companies in the portfolio, you see all these ones highlighted in yellow, they have increased their dividends this year. So as I add new capital, as the positions already in the portfolio pay out dividends, and those dividends buy more shares, and as the companies raise their dividends, those are the way that this dividend snowball continues to increase over time, and currently sits at $11,401.21 paid out from all the positions. Annual income here, this is dividend income that, regardless of whether I continue to add to this portfolio, if I was to stop adding right now, this will continue to grow as the positions pay out dividends and as they raise their dividends over time by about 5.69% dividend growth. So that is very nice to see. And I thought I might get to 12,000 in July. It's going to be close. It's going to be very close, or 12,000, 1,000 per month in dividends received. It's going to be very close to get there by the end of July. We'll see if we make it. I was hoping to be right around 11.5, 11.6 by the end of June, but we didn't quite get there. So we might be a little bit behind our target, but it'll be over the next 2 months anyway. If we don't get there by the end of July, we'll definitely get there by the end of August. And that is the next milestone really for the portfolio, $1,000 a month. And I'm really looking forward to getting there. And I really do appreciate all of you who have tuned in and followed along on this journey. Hopefully you've started your own journey as well. Again, let me know in the comment section below what you're buying, what you're watching, what you may be selling, what you may be avoiding. Would really love to hear from you. And that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Again, real close to 1,000 subscribers. I know there's some of you out there that have been watching the videos that haven't hit that subscribe button. Really help me get to 1,000 subscribers and beyond. So hit that notification bell as well so you're notified whenever we put out any new content. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. I do a stock pick of the day series Monday through Thursday where I cover a stock that's pulled back on the day to see if it's presenting any value. So again, if you have some suggestions for that, put it down in the comment section below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. To never invest any amount. Don't losing it. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.